Hello, everyone, and welcome back to another episode of the What the Finance podcast. And on today's episode, I'm happy to be hosting Scott Nations, founder of Nations Indexes, creator of the VolDex, and author of the recently released book, The Anxious Investor, Mastering the Mental Game of Investing, which is currently available online and at any good bookstore. So, Scott, thanks for joining the podcast. And I guess, can you tell the audience a bit more about yourself and your background and why you wrote the book?
Sure, Anthony. Thank you so much for having me. The book is really intended to be a general interest history and a fun read that will help people understand when their biases, behavioral biases, might cause them some trouble in investing. But let's take a step back. I was a professional option trader on the floor of the Chicago Mercantile Exchange for 25 years. So for those 25 years, I was one of those crazy guys in a bright red polyester jacket jumping up and down. And I started to write a little bit about finance. And as a trader, you're just aware of the behavioral biases all day, every day. And so again, in the book, I write about three famous bubbles and subsequent crashes. And I use that really as the canvas to describe the behavioral biases. And Anthony, the problem with the biases is that none of them help an investor's long-term results. They all hurt. And so I thought there might be a way to talk about those biases in kind of a gentle way rather than a lecturing way. And the way to do that, I think, is to look again at these bubbles and crashes and point out specific instances where people fell prey to their biases. So again, as a professional trader, you're aware of the biases all day, every day, and you realize that even though you're a professional, you're subject to them, and the goal was to help everybody else understand when they come into play.
Yeah, definitely. And you mentioned there, you talk about three, and I think the earliest was the South Sea sort of speculative bubble, which was in the early 1700s. So I found it really interesting how, as you said, that those behavioral habits, they're consistent. Like, even though we've changed so much, there's so much technology, a lot of the same things happened back then as they are happening today.
That's right. And I say that actually in the preface to the book. We think we've gotten so much smarter and so much better at understanding ourselves since, it's been almost exactly 300 years since one of the most famous bubbles and one of the very first finance bubbles, and that's the South Sea bubble. And so we think we've gotten so much smarter, and we've gotten a lot smarter. We've not gotten smart enough. And that the difference now is that everybody here, at least here in the United States, nearly everybody is responsible for their own retirement. So the idea of the old-fashioned pension doesn't exist anymore. So if you're going to finance your retirement or your kids' educations, then the way to do that is in the stock market. And it's just critical now that people understand the ways that they can go astray.
Yeah, and I guess that's one thing, as you mentioned, that I'm sure things have changed a lot since you started in the CME and the pits compared to what they are now. And I guess people would probably say that we've advanced so much, but as you said, there's just so many people who have access to it. There's maybe a lot more retail investment as well, which is actually potentially skewing a lot of the maybe advancements that we've made.
Well, and as an example, one of the biases I talk about is sensation seeking. And that is, too often people will trade, not necessarily invest, but they'll trade stocks because they're seeking the fun of doing so, the sensation. And there are certainly some we'll call them investment platforms that have been launched recently that really augment that sort of trading. And Anthony, as I say in the book, investing shouldn't be a chore. It doesn't have to be an ordeal. But on the other hand, if what you're doing for the sensation of it, then you're probably not doing it for the right reasons, and your results are probably not going to be particularly good.
Yeah, as you said, it's been gamified, and I think a lot of people found that when COVID started, I guess a lot of the gambling, a lot of the sports stopped, so it was almost like a way for them to get that thrill outside of what they'd normally done. And as you said, it wasn't actually investing.
No, it's not investing. It's become something very, very different. And, I enjoy going to Las Vegas every now and again, but I don't kid myself that that's the way I'm going to fund my retirement or my children's educations.
Yeah, and I think it was really interesting in the book. We mentioned there the South Sea sort of bubble. You mentioned Isaac Newton as well, who was quite famous for losing quite a lot of money, even though he was one of the richest. And it was almost like there's this promise that we think we buy into the story, and that's where people really get wrong with it. They buy into the story. They think it's going to go on forever, and then obviously there's a point where it doesn't.
Right, and we over the term that I use in the book is we over extrapolate recent history into the future history. So we think that what has happened over the past week or month or even year is likely to be what happens in the next week or month or year. And unfortunately, that's just not the case. It's not the case at all. And so the book is intended to be fun, but I also want to prove that these biases exist, and I want to quantify them as much as possible. And so I do that in the book, and I use a bunch of research, a bunch of academic research. There's a wonderful amount of it, but I also point out some simple things like the fact that what happens again today or this week or this month in the stock market will have no impact on what happens tomorrow or the next week. If you crunch the numbers just a little bit, you can show that there's no correlation between one day and the next. And so the goal is not only to show investors that they are making this, that they're assuming this, but to quantify how it doesn't exist, or quantify the damage it does to their returns.
Yeah, and do you think this book is more important than ever? Because the three that you mentioned, I think the latest was in 2008, the Great Recession. But a lot of people who are investing at the moment really haven't experienced one of these shocks. Obviously we have COVID, but that was only for a few weeks. It wasn't as systematic as the other shocks that we saw. So do you think it's more important than ever that people learn this, because it could be potentially happening in the future?
You make a good point. I think one of the important things, and I'd like to think that there are a bunch of important points that I make in the book, but one of the important points that we can learn right now is that if you can remember what happened in the stock market on a particular day or over a particular span, then it is almost certainly not normal. As an example, everybody knows what happened in 1929 in the stock market. Everybody knows what happened in 1987. Everybody knows what happened in 2008 and 2009. What that means, though, is that when we think about the stock market, we often have those sorts of things. 1929, 1987, and the Great Recession. Those things often spring to mind first. So there are a couple of things at work there. One is the bias of availability, another is salience. And they just mean that we tend to think that those things that are easy to recall are more common than they are, which is natural. But for the stock market, it's impossible to remember what happened, say, and let's just pick a date. 1958. Who knows what happened in the stock market in 1958? But it's almost certain to be more normal than what happened in 29, 87, 2008. And people do best when they invest for what happens normally, not the extreme events. Now, the extreme events really hurt a lot of people, 2008 and 2009. But my point is, Anthony, is that if you have a long enough time frame, if you have a reasonably long time frame, say 20 or 25 years before you're going to use the money for retirement, then what happens on an average day, on a normal day, is much more important than the occasional crash or panic. And there's a bunch of research that I talk about in the book. A lot of investors invest as if they expect another crash just around the corner. And again, over time, that sort of an investment thesis really does not help your long-term returns.
Yeah, it's interesting. So you'd say it's almost trying to find a balance between, being too exuberant to being too, end of the world.
Right. It's again, if it's easy to recall, then it's probably not normal, and so it's probably a horrible investment thesis.
Yeah, definitely. And then, as you mentioned there, you mentioned quite a few different behavioral biases throughout the book. And I think, it counted up to about 15. So there are a few others that you can mention, and, how do they affect us as investors? And maybe, what techniques do you have to try and make it so they don't affect you?
Let's talk about the techniques first, because I think that's a really interesting way of looking at it. I think simply understanding what the biases are and recognizing that you might fall prey to them when it's time for you to make investment decisions is the right way to approach this. So again, the book's not intended to be a lecture. It's intended to let people see the mistakes that other people have made. And I've had some people say that they'll go through the biases in the book and they're like, not so much that one and not so much that one, maybe not so much that one. This fourth one, that's me. And they'll do something like that. So let's talk about a bias that's probably going to be important to people right now, because the market's had a tough time recently, and that is anchoring. For some reason, people confuse some value that they have in their head with the value of a stock. So they have some number in their head and they confuse that number with the value for a particular stock that they may own in their portfolio. And that is the value that they think that stock has is anchored by some number. It may be what they paid for the stock 3 months ago. It may be the high level that the stock was at 2 months ago. It may be some random number, more or less. And so people do that, and it keeps them from approaching investing with the sort of kind of eye that you really need. We'll say that you need to have you need to approach investing in a way that's not particularly wrapped up in emotion. But if you paid X for the stock 3 months ago and it's now $10 below that, well, if you ask yourself, what is the stock worth? It's worth whatever the market is saying it is today. But too often people will say, no, it's worth what I paid for it 3 months ago. And so I'm not going to do anything, which is really unfortunate, because if nothing else, maybe the right thing to do is just harvest that loss for taxes. So, so the anchor price gets confused with value, and people often don't do the right thing. That also leads to another bias that I'll talk about really quickly, and that is disposition. And that is the tendency for traders and investors to sell their winners and hold their losers. And the problem with this, Anthony, is that people think, oh, I'm selling a winner. I'm going to pat myself on the back because I'm refusing to be greedy. I'm refusing to be greedy. That's good. And I'm holding my losers. I'm refusing to be impatient. Let me pat myself on the back again. I'm refusing to be impatient. And so we fool ourselves into thinking that we're doing the right thing here. But and again, this is called the disposition effect, but there's a ton of data out there. And Professor Terence O'Dean at University of California at Berkeley is probably the leader in this, and I refer to his research. He has shown that when people sell a winner and buy something else, the something else underperforms what they owned originally. So they're actually doing themselves a disservice. And so you think you're being disciplined, and you're not. Why is that? Because you are being greedy. You're being greedy to realize a profit, which unleashes this swirl of chemicals like dopamine in our brain that only happens when we actually realize a profit. And so we think we're not being greedy, but we're being greedy in the extreme. So it's called the disposition effect. I talk about it in the book. I quantify it in the book. And it's one of the worst sorts of biases, because we think we're doing the right thing when we're absolutely doing the wrong thing.
Yeah, and I think if you look at, for most people's portfolios, even for the market in general, the majority of gains have come from a small amount of winners. And we've seen that recently with, the big five tech companies. So you could say that's, if you sold them, then you'd basically be missing out on many of the gains that the market has actually experienced.
And I tell people this, and I say, if you fall for this enough, then what you end up with is a portfolio where you've sold all your winners and all you have left is a bunch of losers. You end up with a portfolio that looks like something from the island of misfit toys.
Yeah, exactly, which is not where you want to be. And the issue is you make that profit, but as you said, you invested in these companies. So you're not even taking any of the money out. So it's just, it's not good for anyone. So that's really interesting. And then in terms of, I think a great example of that, as you mentioned, the dot-com bubble, which is probably the, similar to, I guess, the South Sea bubble, but it's probably the finest example of exuberance and these companies that have no money, no revenue at all, hardly, but they're somehow at these exorbitant value. And at the end of the day, there's anchoring because people don't want to get out, but they actually went down to zero. So I think that was a perfect example.
Right. And there's another bias that I talk about in that context. The idea was originally generated by a couple of British psychologists writing specifically about the internet bubble. And they call it fantastic objects. And that is that investors were just enraptured by some of the personalities and some of the products that were introduced in the late 90s. And we had these wonderfully iconoclastic founders of these businesses, whether Steve Jobs or Bill Gates or some of the other guys. And they felt like these investors felt like they were a little bit closer to these iconoclastic founders if they owned the stock. And so they didn't buy the stock just because they thought it was a good investment. They could feel a little bit closer to these famous people if they owned the stock of the companies that they ran. Sometimes that worked out, sometimes it didn't, but let's face it, that's never going to be a good rationale for owning shares of any business.
Yeah, I think we've seen that recently as well, the cult of personality. And a quote that really resonated with me and I actually shared on Twitter was from the book was, a publicly traded company that aims to change the world may be worthy of your patronage, but that alone doesn't make it a worthy investment, which I think is prime there. You might love the idea, you might like the founder, doesn't mean it's going to be a great investment for yourself.
No, and again, companies that are trying to save the world, that's wonderful. I'm not certain that that's a great thing for shareholders. And I'm not saying that we all ought to go out and buy shares in the companies that are worst for us. But on the other hand, I'm simply saying, go into it with your eyes open. If you're going to buy shares of a company that you think is going to save the world, recognize that you're making an investment for a different sort of reason.
Yeah, and it will be a lot riskier as well. I think there's, you might have to prioritize it rather than putting a lot of your money into it like a lot of people have, or majority of your portfolio. You might be more, putting a smaller percentage of it in.
That would make sense to me. There are certainly companies that deserve our respect. Unfortunately, the question then becomes, because it's an investment, the question then becomes, are they going to make enough profit to make my investment worthwhile?
Yeah, exactly. And that's a really important point. So, if we look at the book, obviously, you're talking about the behavioral biases. You're trying to help people, maybe prevent them from being overtaken by these biases. Is that really the message you want people to take away from the book, that you can control, that there is another way, or what would be the message?
The message is that in this day and age, you essentially have to be an investor. The stock market is a wonderful, wonderful place to build wealth, to save for your retirement, to save for your children's educations. But you have to realize that the stock market's a tough enough place, and so you just need to be aware of these pitfalls. Somebody once said that if you don't know who you are, the stock market can be a really expensive place to find out. Well, Anthony, I guess the point of the book is, let's help you understand a little bit more about who you are so that the stock market becomes a little less expensive.
Yeah, definitely. That's very vital. And I think that's a great quote as well. Maybe if we, because the book's all about behavior, you know, trying to be an anxious investor, but are there any other things yourself as a professional investor that you maybe see
The
retail traders
suggestion I
or other
would
people
make is
making
actually a
mistakes
fairly
that you
simple
could,
one that can
give
be
advice on?
often really difficult to implement, and that is invest, continue to invest, don't stop investing, and invest for the proper time frame. One of the biases I talk about is called myopic loss aversion, which is a big name, whole lot of syllables. What it really means is that regardless of their time frame, people tend to invest their money as if they're going to use it in about a year. So even if you're 25 or 30 and you're saving for your retirement and you're not going to use that money for a long time, people tend to invest that money, they tend to deploy it as if they're going to use it in about a year, which doesn't make any sense. Invest it, deploy it in a manner that is consistent with the fact that you're going to use it in 20 or 25 or 30 years. So, and I talk about how people do that in the book, what that really means. The other thing I would point out, and this goes back to the idea of invest, continue to invest, don't stop investing. One of the worst things that people did in the 2008-2009 timeframe is that, and we talked about this a few minutes ago, Anthony. People tend to think that what's happened recently will continue in the future, and so in say March of 2009, people saw that the stock market had come down so much, they thought, oh, well, that has to continue. And so in February and March of 2009, some investors, a particular swath of investors, sold almost all of their holdings. The sales of equity mutual funds in February and March of 2009 were as big as they have been in decades. So people sold at the bottom. They sold at the absolute bottom. And this is why I say invest, continue to invest, keep investing, don't stop investing. Because these people thought, oh, I'm going to sell here and I'm going to save myself a bunch of money. Well, that's exactly the opposite of what happened, because they sold at the bottom and they didn't get back in until the stock market had rebounded a bunch. Again, I talk about this in the book, and there's some data, although the book's not heavy on data. There is a little bit of data when I need it to prove a point. Don't do that. Don't just keep investing, and don't try and outsmart the market by thinking you're going to sell and save yourself a bunch of money.
Yeah, and I guess there's a classic quote from Warren Buffett where, no matter what is happening in the world, if you look at the last 100 years, the US stock market has drastically gone up a lot, and almost every stock market across the world.
Right, and that's having a time frame of 100 years may not be appropriate for any investor, but a time frame of 20 to 25 years is probably appropriate for a lot of investors. And so think about that. Don't think about what's going to happen next month or next year. Think about what's going to happen between now and the time you're actually going to use the money.
Yeah, definitely. I think that's it's a very important message. So, we mentioned before that you're a part of a company that really focuses on volatility and I guess helping investors take advantage of volatility. So I'm not sure if you can give your insights about your thoughts on the current market, maybe what you're thinking going into the future, or in terms of do you think we're going to see a lot more volatile market compared to the last 15 years?
Well,
Hard to predict, but
I've just said don't try and predict the market, and
yeah,
but to the degree that you can kind of prepare yourself mentally, then maybe this is a valuable exercise. I think it's clear that there's a tremendous amount of inflation. The Federal Reserve wants to limit the negative impact of inflation, and so they're likely to raise interest rates. The reason that doesn't particularly help an investor is that is already baked into the market. Those expectations have already been baked into the market. So it's not like you can outsmart everybody else in the world by doing anything right now. I think things are going to be pretty tough. I think things may be very tough for the next 12 months, 18 months. That doesn't mean I have insight or that you should be selling your investments because you think you're going to buy them back 18 months at a much cheaper price.
Yeah, no, definitely. As you said, most people, and you know, we mentioned before Warren Buffett, he hasn't hardly sold any, and then he's been able to really benefit from that long-term perspective. So that's
Well,
really
and
what most people should do.
right. And Anthony, let's look at it this way. If you are truly going to invest in if you're going to retire in 25 years, you want stocks to be cheaper now because you get to buy them at a discount.
Yeah.
You want them to be cheaper now. So again, if you have a reasonable time frame, then when the stock market goes down, you're like, you shouldn't be, oh my God, this is horrible. You should be, this is fantastic for me. I get to buy all these wonderful companies at a big discount.
Yeah, it's definitely how I'm looking at it, especially. And, I guess I'm lucky I'm sort of out of the market. I'm hoping they go down a bit further to potentially enter, but we'll see. It's hard
And then,
to, as you said, it's hard to predict.
but then what are you going to do if it's 20% higher than what if it gains 20% over the next year? Then what are you going to do? Are you then going to wait for it to come back before you get in? Well, then, you run the risk of missing another 20%. There's something I talk about in the book that I call the trader's prayer. And I said this to myself when I was on the floor. Everybody says it. Every professional trader says this to themselves. And it's, oh God, please just let me get back to even, and then I'll get out. And that has probably cost more traders more money than any other approach. If the approach were instead, I'm going to get out now, I'm going to take my loss, I'm going to reevaluate, and then I'm going to go back with a better understanding. That would be a much better approach. I have said the trader's prayer, and it hardly ever is the right approach.
Yeah, I guess a great example we've seen recently is Bill Ackman, and he's getting out of Netflix, and that's exactly what you said.
You will spend more time and effort, we'll call it husbanding, babying a position that you're underwater on, than can be justified by, how it's going to work out. If you were to just take your loss, move on, you'd be better off.
Yeah, and I guess you could say it's a classic 20-80 rule where, 20% of your stocks might give you 80% of the gains, and maybe 20% of your stocks give you 80% of the worry and concern, as you mentioned there.
Well, and one of the goals of the book is to help people understand what is normal. And so when whatever is normal is occurring, then they'll recognize it. They'll understand it.
Yep. And as you said, most of the time, normal things happen. It's not these crazy events that you talk about in the book. It's just normal.
Right. And the right approach is to invest for what is normal, not what is memorable.
Yep, I think that's great. So, Scott, thanks so much for joining the podcast. And I guess my last question would be, maybe what's the best investing or trading advice that you've ever received? Maybe from someone from the CME or somewhere else.
Well, Anthony, it's been tremendous fun. Thank you for having me. I do draw this big distinction. It's an important distinction between trading on the floor, where your job is to provide liquidity, and investing, which you're going to do again for over a long time frame. I think the best advice anybody can get when it comes to investing is invest, continue to invest, don't stop investing, don't sell thinking you're smarter than the market. And when it comes to investing, invest in a broad-based, inexpensive equity product.
Perfect. Sounds great. So, Scott, thanks again. So we mentioned the Anxious Investor. It's available anywhere. If anyone else wanted to maybe find any more of your work or anything like that, where could they do that?
They can do that at my website, scottnations.com, or they can follow me on Twitter. My Twitter handle is unimaginatively Scott Nations.
You're like me. I was able to get my name as well. It's
there we go. Yep.
Benefit of unique names. But yeah, Scott, thank you so much for your time.
Thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.